for joining us today at this very special Real Circularity in Finance webinar. I will introduce you to our panelists in a second. My name is Lucy Siegle and I'm chair of the Real Circularity Coalition. We're also expecting a couple more panelists, so I'll give them just a couple more minutes to show up, and I'll just explain a little bit about, hi Marte, about what we do and why we wanted to convene this webinar and what I think, or I hope, that you will get out of today. But thank you very much for joining us. I know that there are a lot of demands on everyone's time at the moment, which is understatement of 2020. So I want to say thank you for spending it here. Let me just tell you a little bit about the Real Circularity Coalition so that I can put us in context, as it were. Thank you, Stephen. Let's have a look at the next slide. So we know about the global challenge of waste, and we know that there are a positive that there has never been so much attention, I think I'm right in saying, on this subject. And it's a profound discussion. Things are changing, as we will hear about today, and we are recognizing finally that there is a different way of dealing with waste, and actually a way of dealing with waste and the value of waste, and a very profound and deep discussion that's being had in certain areas and certain sectors. Is it big enough? Is it wide enough? No, I would contend not, but that's part of our remit at the Real Circularity Coalition, to extend and push and further this conversation, and from theory into action as well, which is what we're very, very big on. So we know that 744 million tonnes of waste is sent to landfill each year, and we know that recycling rates remain, well, pitiful really, and certainly for some materials they are, you know, very, very concerning. But we also know that we have a lot of solutions for this, and the big solution, the joined up solution, is the circular economy, and we would contend the real circular economy. Okay, Stephen, next slide, thank you. So the status quo is that we feel often trapped in a linear economy where this take, make and waste, or take, make and discard system is really putting us in opposition with planetary boundaries and ecosystems. And obviously that's an incredibly uncomfortable position to be in when we are facing the dual crises in climate and nature, which at the end of the day is what we are all concerned about, our panelists in particular. So we need a real circular economy now, because we want to transition from a linear economy to one that is circular. Now, I will just mention what we need to define as a semi-circular economy, which is at best a distraction, often greenwashing, and a real problem. And it's a problem not because we at the Real Circularity Coalition are, you know, Puritans or want to be, you know, virtue signaling about how things should be done, or perfectionists. It's a problem because it doesn't deliver, and it doesn't deliver on the climate advantages, the climate wins, or the SDG goals, and it won't deliver where we expect it to deliver. So it's basically a way of perpetuating the status quo. Sometimes it's accidental, but it's something that we see as a real risk, which is why we exist, partly as a corrective, and really to push and drive change towards a real circular economy. Thank you, Stephen. I can't remember if there's any more slides. There is, yes. And this will only be achieved when we get this absolutely right. So when products are designed to be 100% recyclable or reusable, and we look at lots of companion models. So the sharing economy is a big part of what we do: rental, reuse, refill, but also looking at materials that actually are circular and actually can be circular. And it's really important to have that real world conversation, but also that everything is underpinned by the science, by the evidence, by planetary boundaries, by ecosystems thinking, because otherwise we know that we are not moving in the right direction. Okay, next slide, thank you. And this is why we're here today. So the Real Circular Finance offers incredible opportunities, but a way of really underpinning what we are talking about. You'll be familiar with a lot of these figures, but you know, the scale of the opportunity is tantalizing, to say the least. So today we're talking about how do we unlock this opportunity? How do we push forward? Is it real? What do we need? What do our panelists think is needed to accelerate and to carry on transforming? We know that there's a lot of promise being shown, and how do we capitalize on that? So that's why we're here. Thank you very much, Stephen, for the slides. Let me introduce you to our panelists, if I may. And first of all, I want to say thank you to them, really, because between them all, we've got decades, not just of experience in green finance, but what I would term activism. And I checked with the others, Marte, before you came, so I hope you don't mind being called an activist. Everyone else said they found it a compliment. And I say that... Great, good. I don't want to offend anyone at the start, but I say that because our panelists today have really shaped the green finance opportunities that we are looking at now. Some projects, sometimes the marketplace, but different pieces of that jigsaw to make this happen and to put us. It seems strange because we talk about problems constantly, especially around nature and climate, and it seems strange to me in some respects to be talking so much about opportunity, but we really are in a space now that we can push forward and capitalize, I hope. So that's what we'll be talking about today. So thank you to all of you for your incredible work thus far. I'm going to start by introducing each panelist and then asking them to set a sort of position statement, really, and I will introduce them as you meet them, if that makes sense. And the question I'm asking everybody first is circularity the new global investment opportunity? Is circular economy the new renewables, in effect? So that's what I'd like to start off with. Marte, I'm going to start with you because you're on my screen, and I think that's a good place to start. So Marte Borhaug, if you don't know Marte, is Global Head of Sustainable Outcomes at Aviva Investors, and has previously done so many different things. But in particular, for me, Marte joined Aviva from the Confederation of British Industry, the CBI, where she was head of financial services and corporate governance. Before this, she led sustainable finance campaigns in Brussels, at the EU Public Affairs Consultancy, the Brussels office, and the mission of Norway to the EU. And now, leading the Sustainable Outcomes team, she's responsible for ensuring Aviva investors contribute to the SDGs through positive impact. And Marte's team delivers thematic research used across investment capabilities. There's so much to talk to you about, but if we can start with these huge questions, is this the investment opportunity that we all hope it is?
Thank you so much for the very kind introduction, and hi everyone for joining. I've just moved rooms because I have this, we're all working from home now, and I have this school outside my main where I've got my nice bookshelves, but there's a school that just having their break, and you really can't hear me over all the children, so forgive the slight boring background. So is it the new renewables? I think a good place to start is to say, I mean, I wouldn't be here if I didn't think so. So I definitely believe that this is an area that the market is waking up to. Is it the new renewables? I don't think we're there yet. And so I think that's why we need coalitions like this. So just a couple of points for me as from where I sit as an investor that I think, maybe it'd be helpful to kind of set up my position on this, where I think we need to head to make this a new renewables. So first of all, I think that people are waking up to the risk. So I think increasingly we're seeing more regulation coming out in this space that companies have to react to. And the companies that are, I guess, well placed to react to that will benefit from that. And the companies that are not will be punished for that. So we're seeing increasingly that investors are starting to be aware of the risk in the circular economy more broadly. But are investors actually allocating all the capital they need towards it? I would say no, not at all. So I mean, just take one example from the climate debate, but you'll see exactly the same in the biodiversity space as well. If you look at the current FTSE 100, so all the companies across the UK, and you look at the global warming potential, that they are contributing to. So if nothing happens, if all of those companies just continue the way they are today, we'll get to a 3.7 or 8 degrees, right? So, and that's what markets are currently investing in. And so financial markets as a whole are not seeing this as an investment opportunity. They're not shifting capitals enough yet. So I'm hoping that today we can sort of uncover some of the solutions to that. But just to flag a couple of those areas from my perspective, I think one of the big areas is getting some really good, a lot better data and information about the companies, but data that it allows us as investors to assess whether a company is good or bad. You talked about real circularity. There's a lot of talk out in the market, but it can sometimes be difficult for investors unless you have the research capability. I mean, we do that as a big investor, active investor, but a lot of smaller investors out there don't have that sort of luxury. So good data sets out there that will really rank companies, and one of the ones that we're supporting that people may or may not be aware of is the World Benchmarking Alliance. So it's a global ranking of companies. They're going to rank 750 keystone companies around the world on their circularity. So initiatives like that really helps give us a sort of, here are the leaders, here are the laggards, this is the people we want to shift capital away from, and here's the people we want to shift capital towards. I think just finishing off, a final point is around engagement. We're a big, I think a really big thing that more and more investors are waking up to is the need to go and meet companies, talk to companies and engage with them. And so it's not just about investing. So you could talk about renewables as an example. We used to not just look at the renewable energy companies, we also look at the big fossil fuel companies and push them to change. And we're seeing a lot of them now finally waking up and setting net zero strategies, etc. So what do we need to do as an investor community to push companies to change so that you have those innovators that we can really speed up, but also that we bring some of those big companies that are having such a negative impact today, let's engage with them to really push them forward.
Great, there's so much insight there. Thank you. We'll come back to some of that, hopefully, Marte, and pick some of that up. Audience, please do ask questions as well. There's a Q&A box. Please fire away. We will hopefully get to those. Hi to Hein, who's joined us as well. I'm going to go to Sébastien next. Sébastien Soleille, who's Head of Energy and Environment Transition at BNP Paribas. He has over 17 years of experience in sustainable development, ecology and energy transition, energy and climate politics, renewable energy, and much, much more. Now, in May 2019, BNP Paribas launched a circular economy exchange traded fund ETF that invests in companies with circularity at their heart. Now, presumably, Sébastien, just coming back to our initial questions, you think circularity is a very good global investment opportunity. Is it the new renewables for you?
Thanks, Lucy. Good afternoon, everybody. So obviously, yes, we think it's very important. So in BNP Paribas, we are convinced that we have to align all our activities with the goal, the climate goal of the Paris Agreement, with the preservation of biodiversity, with the achievement of the SDGs. So yes, all our activities have to integrate all of this at their core. And for this, we need clearly circular economy. We need circular economy to minimize the consumption of natural resources. We need circular economy to minimize the quantity of waste. We need circular economy to decrease the energy consumption, because producing goods and wasting goods require energy. So clearly, circular economy is required at the heart of all our economic activities, and so at the heart of the economic activity of the bank as well. It's quite, nonetheless, it's quite different from the renewable for different things, not for a matter of importance per se, but renewable energy is quite clear to define. When you invest in a wind farm, you know it's a wind farm, you know what it is, and you know where you put money in. Circular economy, the definition is much more complex to give clearly. It's much more fuzzy. So what is circular, what is not? There is not necessarily a clear limit. And your introduction on this was quite enlightening. You have circular economy and real circular economy. Okay, or can we make the difference between the fake circular economy and the real circular economy? So, the first difference between renewable and circular economy is that a circular economy is something more difficult to define than renewable. And the other thing that is quite important is the impacts. So when we invest in some things, we like assessing the impacts of our investment. When we invest in a wind farm or a solar farm or whatever, okay, there is a number of watt or watt hours or whatever, a quantity of energy produced. That is, so we know that if we invest in this wind farm, there will be such quantity of renewable energy available on the grid. Okay, that's fine. If we invest in circular economy, it's more difficult. It's not impossible, but it's much more difficult to define the precise impacts in terms of circularity, in terms of waste, in terms of resources. It's more difficult. So yes, it's very important, and yes, we must put circular economy at the heart of our activities, but it's, in my view, more complex to understand, more complex to define, more complex to assess than renewable energies. And so we have to define new ways to deal with it. And yes, we try. So with all our activities and with this ETF and with yes, what we do in terms of development of circular economy, we try to develop new ways to assess and measure and define circular economy.
Thank you so much, Sébastien. I'm so glad that you approve of our brutal defining of real as opposed to fake. We think it is useful and very, very necessary. I'm just noticing the time, our panelists, and there was so much to unwrap in this, and we're already getting a lot of questions through. So I'm going to come to you now, Keith. I'm going to intro you, and then as well as telling me your position as where you feel, in whether you feel this is a new global investment opportunity. We were talking before we started this, and you gave a very specific example of some innovation. And I think that's starting to speak to Sébastien's points about taxonomy, yes, but also quantifying and how you get different solutions to some of these problems, which seem quite complex. Now, Keith Tuffley, if you haven't met Keith, he really has got such an incredible overview on this topic. So Keith is now the global co-head of Sustainability and Corporate Transitions Group at Citigroup. I met Keith when he was the CEO of the B Team, an NGO which advocates a positive role that business can play in solving many global challenges. He's also chairman of the Global Footprint Network and governor of WWF Australia, and many other things. But Keith, also have your own impact investment company, where your core purpose, you say, is to reduce the human ecological footprint. So this is what I mean today about our panelists coming back to that essence, that activism that I talk about, because obviously there is no point if it doesn't work. So my many questions to you, Keith: what works? What do you think is working? Do you think this is the next renewables? And how do you scan for innovation that addresses these points, but could in a way that you can also quantify the impact?
Yeah, well, thank you, Lucy. Great to see you again, and hi, my fellow panelists. So look, there's some great questions there. I think to address your first point about the innovation, I'll just give you an example of an innovation that we have been part of in the last week, and with other banks, including BNP Paribas as well, which is a really interesting breakthrough structure for a new bond issuance. In the last 12, 15 months, there's been a range of these new financial instruments, bonds that have been linked with economics of them have been linked to a particular KPI, key performance indicator, a non-financial KPI. So it started off with Enel, big Italian power company last year, whereby the bond coupon is linked directly to their decarbonisation targets in the company. Now, last week, it was the first time ever that a KPI-linked convertible bond, which is a bond which has equity features attached to it. So that's a breakthrough in itself. But probably the biggest breakthrough was that it wasn't just a decarbonisation KPI, it was also 2 other social KPIs, one of which is a gender diversity KPI, such that, in effect, investors are directly linking the economics of the bond to a gender diversity target within the workforce of Schneider Electric. So in a way, well, it's direct. It's the investors get less if, well, so I'll put it the other way. They get more if the company fails to achieve the target. i.e. the conversion coupon goes up if the company fails to achieve a gender diversity target in the company. Fantastic breakthrough. Another target they have is training 1 million underprivileged people on energy management. Again, if they fail to achieve that target, then the conversion premium increases. So it's going to open up a whole new range of these types of products whereby investors are buying into the non-financial key performance indicators for the business. Now, what's the next step? Well, the next step should be, Lucy, that there should be a circular economy, a circular features in future products, whereby companies are encouraged to develop circular economy features into their business model, and secondly, that they are linking those to the financing for the business itself. So that's the next area for exploration. So I think another point you're raising, Lucy, is around how do we effectively create ongoing increase in prosperity, jobs, employment, economic growth, etc., but effectively by becoming smaller, right? That's the concept, or at least lighter. That's the concept of reducing our ecological footprint. Now we've got probably three massive challenges in the world represented by the Sustainable Development Goals. One clearly is climate change, so SDG 13. Secondly, it's the nature and biodiversity challenge we face. That is an equally big challenge. It's related to climate. It's a solution provider for climate, nature-based solutions, but it's also different to climate. Microplastics that end up in the oceans is not related directly to climate. It's nature and biodiversity, because the way we create artificial products and then end up not capturing them, and they end up in our oceans, end up in our food chain for those that eat sea life, and that's detrimental for everyone. So that's the second big. The third big theme in the SDGs is around inequalities. So all the other, or most of the other SDGs relate to a certain extent to inequalities in the world. They're the three, if you put it simply, the three really big buckets of challenge we face. The shift to renewables address only some of those challenges, right? So your question, Lucy, about is this the next big thing in terms of compared to renewables? Well, I would argue it's probably even bigger. As Marte said at the start, it's definitely not there yet, definitely not. But it is fundamental for us to address the others. It has to be to help address the climate challenge, because the whole energy system globally has to shift. It's not just about renewables again, but it's also about the systems by way which we create and use and provide energy. Nature and biodiversity, it's how the food and ag sector works. It's how we extract. It's a fundamentally, in terms of nature and biodiversity, we are destroying the planet in effect. So we need to use the circular concepts to reduce that. And on top of that, it also has to continue to drive economic development and improvement, i.e. to ensure that we are addressing inequalities in the world. So certainly we see it as being a way potentially bigger than the shift towards renewables, but there's a lot of innovation required, a lot of development, and a lot of investment to achieve it. But we're very excited about it.
Thank you for that. It's reminding me of that old saying that someone once said about football. It's not a matter of life and death. It's much more important than that. I'm sort of getting that feeling about circular finance, circular investment. Damian, thank you so much. I think you've been answering some of the questions that have come in on the chat as well, which is excellent value for money and no money, because we're not paying you. Thank you so much.
Even better value.
Exactly. Let me introduce everyone to Damian. Now, Damian Payiatakis is the head of impact investing at Barclays, and leading the launch of an impact investing business for clients of Barclays to protect and grow their capital while making a positive contribution. And through Damian's influence, Barclays is committed to enable clients to incorporate impacts into how they invest and offer investment opportunities ranging from angel investment, private and equity, venture capital, listed equity and bond funds. And before Barclays, Damian was a global expert at Accenture on organizational effectiveness, and has just got a huge amount of experience. So let's draw on some of that right now. I'm duty bound to ask you the opening question, even though I feel we're like moving on beyond that. Is circularity the new global investment opportunity, the new renewables? I'm also really struck, just building on what we've just heard, especially from Keith. So there's, you know, the circular ESG funds are, you know, supposedly the key to addressing all sorts of advantages and benefits. So addressing climate change, resilient economic systems, a mechanism for delivering the SDGs, jobs, all of these things. Do you think that's true? Can it deliver all of these things? Is there a strength and a weakness? Is there an element that its circular economy is more likely to be effective at addressing? I wonder if I could ask you that as well as the other. Thank you.
Happily. And I guess maybe to take a slightly contrary view or conflicting view to everybody else, to your first question, no, actually, I don't think circularity is the next global investment opportunity. And in that sense, while very clearly and definitively committed believer in the concepts of cradle to cradle, sort of the origin of circular economy, and also all the circular economy work, the reality is that those concepts themselves are not investable. So what is investable, there are two things. One are the companies who are incorporating some of these concepts into their operating practices. And secondly are the companies whose business models are actually using circular economy concepts or business model concepts to actually find opportunities. So we've got somebody on the line who is looking at a circular economy, you know, reuse model. And there are some others that we can talk about. So let's take those apart and explain why circularity itself is not investable, but there are still investment opportunities behind it. So when we think about it, or when we're looking at integrating circular economy into a company, you know, you are thinking about the operating practices and actually going a little bit to what Keith said. Actually, I think about it oftentimes in the 5 goods from the cradle to cradle space or Bill's space, Bill McDonough's space, you know, good materials, good economy, good energy, good water, good livelihoods, right? All those things that you're talking about. And that's really when you start thinking about how companies are operating. So if I think, so actually we've got Mike Werner from who's the head of circular economy at Google. Is Google a circularity company? No, arguably not. However, very clearly what they've done in terms of their operating practices, you know, committing to zero waste, you know, in terms of their server farms and actually recycling and reusing, you know, harvesting servers to continue to keep those materials in use, helps to lower cost and actually keep, you know, circular economy thinking in practice. A lot of the buildings they have built are based around a lot of those 5 good principles in terms of how they operate. So you do see, you know, their work on rare earth materials, you know, very clearly bringing those into how they're operating as an organization is critical to both a commercial and to a consumer, and also to the operating practices and the commitments they have as a business. And we see that elsewhere. I mean, you know, Amazon, for example, in the US has recently launched cradle to cradle certified products because in a good materials perspective, there's no point in circulating toxins, right? We can have a circular economy, but if you're just circulating toxins in the world, you are retoxifying the world as opposed to improving it. And therefore, starting with some of those good materials principles is really important. And you see that in other examples as well, Replenish, or actually C&A, another fashion brand, thinking about how they were producing jeans and t-shirts recently. So on one hand, from a company perspective, if you're bringing that in, and as investors, if you're looking at that, so if Marta's looking at that, or Sébastien or the team are looking at that, you're thinking, okay, does this give this company an advantage relative to everybody else in terms of how they're operating? But it's no different in some ways than total quality management or lean practices in that sense. On the other hand, if you are starting to look at companies whose business models are based around it, you do start to see where there are product to product, waste to product models that are very interesting, certainly in redefining how some of these industries work. If I think about our unreasonable impact, so we sponsor an accelerator program the last few years, running cohorts, the US, Europe, and Asia, 130 companies scaling, really, Series B, C, D companies that are scaling. And actually, when we went back and looked at it, about a third of them have business models that are built around circular economy concepts. But the reality is they span sectors as well. So oleo in the UK, for any of you aware, right? It's a waste. It's a waste. It's a food that we aren't eating, being able to share that with others. It's a sharing economy app. River Simple, really interesting hydrogen-powered car, but the way that they designed it is product as a service. So you're actually renting mileage from them. Globe Chain. So Globe Chain takes, as and when we get there, all the office refurbishments and finds a way to get them to other countries or other communities that need them more than the big businesses who basically are stripping them out. And therefore that reuse concept, again, in practice. So in that sense, you could argue, well, yes, those are investable, absolutely, in some really interesting companies. But ultimately, those span different sectors of the economy. So circularity itself, going back to my original point, not investable. The principles and the concepts that will drive both our selection of better quality companies, and certainly on a large cap basis, and companies that are transforming or disrupting industries on a small cap basis, those things you can invest into.
So what do you make of dedicated funds, and how should they be described?
Yeah, it's a great point, because I think what will end up happening is in some ways, a lot of investors will look under the hood of those funds and go, wait a second, I recognize this company. What makes them more or less circular? Now, very clearly, there are some, synergy, which is spun out of Philips as a lighting as a service company will clearly be recognizable. But where other companies are, through, again, their products and services are using circularity concepts, I think some investors may start to question the validity of that topic. I think very clearly in a private market space, you have more of an opportunity to find dedicated companies that are solving some of those problems. But then it is, again, a question from an investment thesis and how much do you believe in the investment manager to stay in line with are they focused on one, either sector or thematic, right? Within that, we're only investing in product to product companies or only investing in waste to product companies. Or are you saying, well, actually, circularity is something that we can bring to bear across multiple industries, and therefore, as an investor, that diversification makes sense to you? So I think it'll be interesting to see. I think without a doubt, and that's the great thing, in the report that you and actually, I can't remember who was on the chat, referenced Ellen's, the MacArthur Foundation's paper on the growth. I think that's where it becomes valuable because it brings to life and brings to light more of what Keith was saying before. Right? We need to have more visibility around these topics. It can't just be about clean energy in order to solve the global and systemic problems that we have, even if I think some people will very clearly question the underlying holdings of some of the managers.
Okay, this is so fascinating. I'm going to move on, but I think we'll probably come back and pick up some points there because I'm sure there are some panelists who would like to pick up some points. Thank you so much, Damian. And Hein, Brekelmans, are you there?
Yes, I am.
Great, thank you for joining us. Let me introduce you to everybody. Hein is head of the Sustainable Finance Desk at ABN AMRO and leads the way in the SFD's mission to accelerate the transition to a circular low-carbon economy with a team of 20 sustainable finance specialists. Hein works across the country for all sectors with a view for the SFD to support and inspire relationship managers in the country to provide sustainable financing to ABN AMRO's corporate clients. So we have our question, our set question for you. Do you think that that circularity is the next renewables? And I wonder if you would like to pick up on anything that Damian says, but it would be very interesting to hear your position.
Yeah, my position is circularity the new renewables? Potentially on impact, I would say fully yes, but in reality, no, because we see a lot of boundaries for us as banks, but also in the system that hinder the transition towards the circular economy. For us as banks, we see circularity is in many instances it's innovation, and innovation and banks are not a happy marriage. It's more the equity side that needs to step into the circularity first, because the risks are too high for us. We in many instances we don't have grip on the assets, which is very difficult for us as banks, because we want to have securitized the assets. The ownership is somewhere else. If you look at product as a service, in many instances we have a longer tenor, which is also very difficult for us as banks. And in many instances, the transaction costs in relation to the deal volume is relatively high. So if you want to structure a product as a service transaction properly, you need to structure it as a windmill, a wind farm, or how do you call it, an offshore wind farm. And if you have a 1 billion offshore wind farm, you can pay for 200 or 300,000 euros on legal costs. That's no issue at all. But if you have a volume of 1 million and you need to pay some legal costs, then it's impossible. But most importantly, in my opinion, we need a system change in order to make the transition towards the circular economy. To give you an example, or the best example is our taxation. If we look at our taxation, if the circular economy is material extensive, that's the goal of the circular economy. But as a result, we see much labor intensity. So in many instances, those circular business models show a lot of labor intensity. What we see in Europe is that the 51% of all taxes is levied on labor, and only 6% comes from material and from natural resources and from material. In other words, with our most important steering mechanism as governments, we are stimulating companies to be as linear as possible, because the taxation is on the labor. So that's the world upside down. If you want to, you need to create a level playing field. So if you are a shareholder and you look only at euros or pounds or dollars, I don't care. If you look only at the financial value, you are stupid to make the transition to a circular economy, because you destroy financial value. The ecological value and the social value that you add as a circular company is not seen by the shareholder as such. So also another example is depreciation. We say we fiscally incentivize companies to depreciate as soon as possible to zero. That's contrary to what we want with a circular economy. We say no, assets remain their value. So this whole system needs to be changed. We say, okay, you need to cooperate within the value chain. If you have a small farmer and you have a food manufacturer and you have a retailer, they need to cooperate. Well, the retailer will say, why should I cooperate? I make the most money in the value chain. I'm not going to cooperate. So everybody says you need to cooperate in the value chain. Theoretically, yes, that's true. Does it happen in reality? No, it doesn't happen. So and most importantly, companies at this moment, they have no trigger at all to make the transition towards a circular business model. Why should they? Because they make a lot of money by doing the things in a linear way. So in theory, and then I end, in theory, the circular economy is fantastic, but we need to change the rules of the game in order to create a level playing field between linear companies and circular companies, and then the market can do its work. That's my opinion. So that's my very brief. That's it. Yeah.
Thank you so much. That was an absolute tour de force. That was amazing. We have so much to unpick there. I'm now going to start bringing it back to the other panelists, and I'm going to fold in some of the questions that we've got from the audience. So Marte, I'm going to come to you. Do you have any remedies for Hein? And could I fold in a question here from Eleanor, who is from Marshall Wace Asset Management? Eleanor's talking about, following on from your engagement comments, and as an ESG manager, could you share your views on group engagements, sharing concern, initiatives like climate action outside of these? Is that more effective than individual engagements? And the reason why I'm trying to fold that in is because I'm asking you where the remedies are, and maybe some of them are to be found within outside engagement. And I would also like you to reference, sorry to be so prescriptive, but I had a question I really wanted to ask you as well. You've called for a global Green New Deal to square the economy circle. I like the mixing of shapes there. And presumably that would bring some of the remedies that we need. So over to you. Thank you.
Yeah, I think, I mean, I think I can start there and I'll finish off on the engagement. But I mean, everything Hein was saying rings very true to me as a person who's worked a lot with governments in the past, and that probably answers your questions about our call for a Green Deal. What we actually initially talked about, and we're still talking about this, and I think it's a concept that people quite like, is that we need a Marshall Plan for the planet. And, you know, if you go back to 1948, there was the Marshall Plan. Many people, we will all know about it, but how big was it? Well, it was 13 billion to rebuild Europe, 13 billion. What we actually need, or sort of the scale of the challenge to deliver on the Sustainable Development Goals, you know, all the challenges that Keith was talking about earlier on inequality, poverty, circularity, we actually need as much as 50 Marshall Plans every year up to 2030. And so that can be a bit daunting, I think, for a lot of people. But I always sort of finish off on a kind of positive note to say, we sometimes do forget how much money is in capital markets. So, you know, there's different numbers out there, but between 150, 200 trillion of dollars of assets are actually sort of up in the capital markets. And so our kind of call to action is two things. One is, first of all, we need to know where is the money going today. And so I don't know if you ask the Chancellor of the UK, and he said how much capital has actually gone into green and circular versus the others, probably he'll find it hard to answer that question. And I think what we need is, and we're calling for this ahead of the COP negotiations next year, COP26 that will be hosted here in the UK, we're calling for this, what we call like a temperature check on the capital of the world. So every year we know whether the temperature is getting warmer. We hear from WWF how we're losing more and more species, but what's happening to the money? So we're calling for, through a sort of global alliance called the International Panel on Climate Finance, we're saying, let's get together, let's work with governments and investors to really get a temperature check, annual temperature check on where the money is going. And then we will know more clearly where we need to sort of allocate the capital. But definitely you need governments to be involved. They need to know where the money is going today, and then they need to take action to make that money go different places through taxation, which is a really good point, through removing subsidies. We know, for example, there's a lot of subsidies still going into very unsustainable fisheries, unsustainable business practices. So there's lots of sort of levers that policymakers can pull. And so if anyone is sitting out there wanting to join the alliance, then do let us know. And I think there's probably a bit of collaboration we can do with the Real Circularity Coalition as well as part of that. Finishing off on engagement. So how do we drive change as an investor? You can do that in a couple of ways. We do it through individual engagement with companies and through collaborative initiatives. And there are pros and cons with both. I think there are a lot of good, strong collaborative initiatives out there, but they're only good if you have a very clear ask to the companies. If there is so Climate Action 100, for example, has been very good because it's a very clear ask, set a clear target, and you prioritize the companies you're targeting, and you have individual investors that sort of pull up and really do the work to push these companies to change. So, for example, we as an investor led a resolution at the BP General Assembly as part of the Climate Action 100 with 2 other investors, but that took about 18 months of work to do all the work, meet with the management, and we got the support. BP now has a really strong net zero strategy, but that takes a lot of work. So collaborative initiatives is a good way to be part of something big, but you still need to do the work. Individual engagement we find is very, very important as an investor, but it takes time to build up that credibility with companies. I think sort of our experience is companies don't listen to investors if all you do is write a letter once a year, or you show up at an AGM once a year and vote. Companies actually want to have a good dialogue. We find that the best engagements we do is when we actually have a really good collaboration between the company and the investor, where we're trying to understand what are their barriers, where are they heading, and we try and be very clear on where we expect them to be heading. And then you actually come up with really good example. You come up with good sort of strategies for change. It is resource intensive, so you need to prioritize. We do that from a top-down perspective and a bottom-up perspective. So we look at our holdings, we look at the top themes we want to tackle. Racial inequality is one of them for next year. Climate change is obviously one, biodiversity another one. So you combine basically the sort of end outcome you have in mind with the sort of generally basically where are you holding capital. But I do think companies are really keen to get into a dialogue more and more, and they're seeing more and more investors are caring. So let's get a temperature check on the planet. Let's change some of the government rules, and let's engage just generally a lot more.
Okay, thank you so much for that. And yes, we'd love to collaborate with you. We're here. That's our whole purpose is to be collaborative. So thank you for that. We have an interesting question here. I'm going to read it out and then I'm going to apportion it to a couple of people. But if anyone else in the panel really wants to butt in, just shout at me or put your hand up, whatever. This is from Chris Butler Stroud. Will we see a time when sovereign credit ratings and companies' credit ratings will reflect their ESG practice rankings, and that will therefore create a feedback mechanism that drives transformational change? Chris notes that the current US administration has tried to stop ESG values being used for pension fund investment decisions. Are we going in the right direction? And is the current US situation just a blip? Because business will still drive change. Keith, is that something that you could comment on?
Yep, very, very happy to. Well, there's two great questions there, two great questions. And I'm just going to get them up to make sure I've got them. That was from Chris. Yeah, so firstly on the credit rating question. So first, as we know, there's the credit rating agencies and there's the ESG rating agencies, and the ESG rating agencies play a great role. It's a tough area to be developing ratings out of, right? It's very fragmented. It's more challenging in our view, in my view at least, to sort of credit. There's so many factors that go into assessing a company's or an investor's ESG practices. There's a backward-looking view, there's a current view, and there's a forward-looking view. For example, you could argue where you are today, you're a business today, and you have to transition. Are you more or less risky and taking a more proactive stance because of what you're doing about it and the vision you hold into the future, as opposed to what you are today? So there's an issue about momentum of change versus a static position or where you have come from. I think when the specific question is, will it be incorporated into credit ratings? I think fundamentally, yes, over time. It's not yet. There are elements of which the credit rating agencies are including pieces of sustainability and ESG into their overall assessment, but it's got a long way to go. The whole concept of stranded assets will be bringing this to the forefront of credit, not just sort of non-credit analysis of what companies are doing. We've got to remember that credit rating agencies and the concept of credit ratings was developed really during the period of shareholder value, thinking about the role of business. Take us back to the 70s and 80s with the whole concept of Milton Friedman, the Chicago School of Economics, and what we're here for. That is to make as much money as possible for companies and the world will be a better place. That's fundamentally changed now to where the whole concept of stakeholder value, if not a step beyond that, is evolving. So yes, the credit rating agencies need to develop, and they will have to over time. The US administration, it's a really interesting question, this one. Some would actually argue that despite the previous or the current US administration's efforts to stop ESG values being used for pension fund investment decisions, it slightly misses one point, which is that it's not just about doing good as if it's one or the other. What we've seen in the last 12 to 18 months is that there is much greater causation and alignment between sustainability practices and the drive for financial value. So in fact, I would argue that it is definitively linked that a better company that drives sustainability practices over time should, all other things being equal, which they're not, but all other things being equal, will drive more financial value. Okay. Now, of course, there's a lot of noise in that So to properly assess it, you can only do it over time across a range of different investments and across a lot of data. But it should, over time. Now, there is a fundamental systemic risk we face, or systemic challenge we face, which I think Damian and Hein picked up on. We absolutely need to have systemic change to drive circular economy concepts. And the single bit, and there's a few systemic challenges, but one of which is fundamental, is we don't price externalities in our system. And that is a complete fault in our capitalist system at the moment. It's fine when we live on an infinite planet. If we lived in an infinite universe where everything ultimately is usable, you don't have to worry about externalities. But on a small planet, we do. And that's where we are now. We've got to a stage with 7.6 billion going to 9.5 billion and increasing wealth, etc., is that we need now to internalize externalities. And that means measuring them. It means disclosing them. It means putting them into our financial accounts, and it means paying for them. It needs those 4 steps to properly work. Just by disclosing them is not enough. So the whole concept of externalities is fundamental to the success of the circular economy. I think that addresses Damian and Hein's points about, can it be big enough? My view is it can be, but we do need systemic change to affect it.
Thank you for that. That was brilliant. Thank you. Sébastien, I was actually just going to come to you. So yes, please.
Thank you. So yes, I agree with what Kes just said. It was very interesting, and I agree with him on this point. Globally, we are convinced that if a company sticks really to a linear economy model, it will release a lot of waste in the environment. So it will have reputation issues, because more and more people are quite concerned with the problem of waste, especially plastic waste. So such company will have a reputation issue. If a company still consumes a lot of non-renewable material resources, in the end, in the mid to long term, it will have a problem of resilience. It will have problem for its supply chain, so disruption of supply chain and these kind of things. So we're quite convinced that a company sticking to a linear economy don't have a really sustainable business model. And by saying a sustainable business model, it doesn't have a business model that can last in the short to mid term. So in the end, will it take 2 years, 4 years, 1 decade? But if a company does not develop circular economy, it should have an impact on its risk profile and on its credit rating. So yes, more and more we think that there will be a convergence between sustainable business models, and so circular business models, and better credit ratings. So yes, we think that there is definitely a link between them. For the time being, it's not obvious probably, but in 1 year, 2 years, it will be more and more, more and more relevant, and more and more the case, I think.
Okay, thank you. That's really useful. I'm just going to a question that we had sent to us pre the discussion. This is from Ian Moat, Waste to Where. What do sustainability finance or circularity funds look for most when choosing who to fund? And what makes a potential partner stand out from the crowd? Hein, is that something that you could speak to?
What was the exact, can you briefly summarize the question, because I didn't really understand it. What?
Yeah, so what would funds, who would they invest in? So what would they look for when choosing who to fund?
Well, at this point in time, we look for companies that can compete with linear companies. So if you look at value recovery or something like that, so recovering value out of waste streams, those are in some instances competitive. Those companies that are the companies that we are looking for right now in circularity. But if you look at product as a service, that's really, really difficult to finance right now, because it turns the whole world upside down. And I still need to find the first financial institution who has done multiple product as a service deals. So we look at something that is more or less competitive to the normal world right now. That is something that we are looking for. So that's a not really an optimistic answer, I understand.
That's absolutely fine. We will take negative, pessimism and optimistic answers. Does anyone have an optimistic answer? Or any more clues? Damian, I feel like you've got something to say here.
Yeah, so in some ways, and I expect Hein also, you're asking what differentiates, and I think in some ways nothing differentiates, right? The standard things that any investor, if I'm thinking about a private equity investor, early stage, or a VC, or an angel, one of our families who's looking at a company, they do want to look at the good old triumvirate, the team, the product market, and the capabilities there. So that actually is standard. We're not going to look any differently, and I don't expect any family or any investor to look any differently at that on that basis. Thereafter, I think what makes companies stand out is how far along they've gotten from a concept to a real world testing in a product, to a revenue model, to a commercial model, right? The further along you are in de-risking that, the more attractive you are. Right. And therefore, in some ways, your question is as much what type of investor do you want, and how much risk do they want to take with you, as much as where are you? So the further along you can get, the more demonstration I've de-risked this as a concept into a product, into a commercial model that is scalable, the more attractive you end up being. But along that, quite honestly, it's no different from an AI company, who's competing against a whole bunch of other AI companies in some respects. That being said, Hein makes a couple of great points in terms of, and I look at the investments world, but obviously talking to our, credit, our traditional lending guys, if you are involved in things that do require more of that asset, the residual value of assets, and how do you assess those, and how do you cost those, it becomes incredibly difficult, right? We spend months trying to think about EV and batteries and EVs, and how do you assess the residual value of batteries and EVs, and is there a business? What does finance look like differently when you're talking about fleet financing for electric vehicles with the residual value and ownership of the batteries themselves not being attached to the company or the organization? So that may be a small subcase, but very clearly an important model, circular economy model that needs to be solved. And I think we are all trying to work on that. So Hein, happy to put you in touch with the guys scratching their head in the same way as such. But I think going back to it, if the question is, how do I find finance? It is the same way you would do and elsewhere. I think you actually have a benefit at the moment, quite honestly. The number of individuals, and again, going back to the funds that have launched, are actively seeking high quality businesses. But the difference of what makes a high quality circular or sustainable business versus another one, there's nothing that is, in my mind, going to truly differentiate. Yes, you can have labels and qualities and who the founders are, and all those types of things are material. But actually, it's just having a really good business that somebody can believe in.
You mentioned a couple of sources there, and just to say that we've had a few questions, people wanting more information, a couple of sources for things that panelists have mentioned. So we'll pass those on to you, because it's not fair for you to have to come up with them right now. But yeah, lots of facilitating of information, which is also what we're about. So we're coming up to the end, and I would like to end with Marte, and I'd like to ask you a little bit we've heard a lot about things like the way the system externalizes the true cost, the true impact. We've heard a lot about how it's, I think Hein referred to the world turned upside down and how the logic doesn't follow through. I want to ask you, I'm sorry, this is a slightly abstract question, but I'm coming back to the point that a lot of us here today are from, have a deeply ecological perspective. So we're looking at planetary boundaries, we're looking at the realities and the truth about climate emissions. And Hitesh Patel, who's joined us today from the Born Free Foundation, makes such a strong makes the point there's a strong link between climate change and biodiversity loss. One example is water scarcity due to climate change in Africa, forcing species to go beyond their territory. These are the realities, the ecosystem realities. Would things be different if people in the finance industry viewed things through this prism first? So if Earth logic dictated the way that we operated, and are we seeing any moves? Has there been any infiltration where the ecosystem is put first?
That is such a good question and a big question. And I'll try and answer it in a sort of... You've
got 60 seconds, sorry.
Yeah, so in a short way. So I, as an investor and a protester, I think that we're seeing a huge shift in the market. I mean, just in the last 18 months, we are, lots of new funds have launched, lots of new actors who were never working in this space. I mean, we've been working on this for decades as Aviva investors, but we're now seeing lots of new players coming into the impact space. So definitely there's a kind of awakening, and I call it a widening. What we do need to see, though, is a deepening. So we need to see people spending more resourcing their team, spending much more time on research, spending time engaging with companies, spending time working with NGOs out there. And so it's not going to be enough, a bit like a band. It's not going to be enough to become really popular. You also need to make sure that you get some real fans that's going to come and show up at the concert and continue to kind of support you. So I guess that's the real call to action, is let's make sure that we retain people's attention and that we really deepen the interest in the circular economy and tackling the earth issues more broadly. But I'm an optimist. I think next year is going to be big. We've got COP26, we've got the CBD, the biodiversity convention negotiations coming. So if it's not going to be a big year for nature next year, then I can't possibly think of another year that's going to be as impactful.
Thank you so much, Marte, and thank you to our audience, whether you're real fans of this or you've just come along. I hope we've enticed you. We do lots of webinars like this at this level with really amazing speakers, so please watch out for our programme of events. And I just want to say a massive thank you to our panellists, to Keith, to Sébastien, to Damian, to Marte and to Hein. Thank you so much. That hour has flown by. We will harvest the questions, and we will try and stay in touch with everybody, because this is also about building this pivotal collaboration, this coalition. Thank you from the Real Circularity Coalition, and I will see you next time. Thanks a lot. Bye-bye.
Thank you, Lucy.
Thank you, Lucy.
Thank you.
Bye.